right, getting right into the reporting season. Overall, it was a very volatile reporting season. If you guys have heard any of the headlines, the average stock price move on the day of the result was 7.7% for the average stock across the ASX 200, which is actually the highest that it's ever been. So it was a very volatile reporting season. But with regards to dividends, it was kind of as we had expected going in that the average dividend increase was 26%, which looks high, but averages can be very deceiving because a certain stock like Evolution Mining, a gold miner, increased its dividends 160%. So we don't believe you should focus on averages. We think the median measure is a good indication of how the kind of average Australian stock is going, and that was up 5.6% in the reporting season. And when you look on the bottom line of the text, sorry, there's a bit too much text, but 64% of companies increased dividends compared with 21% that reduced dividends. And that's pretty normal across the Australian market, that kind of ratio of 3 to 1. So overall, in dividends wise, it was a pretty kind of average season, except for the total dollar value of dividends was actually down 2.2%. And so you might go, okay, well, how come the median was 5.6% and the total dollar value is down 2.2%? Well, that was largely because there were big dividend cuts from some of the big resource companies that are obviously a large weight in the index. And so you saw Fortescue reduce its dividends by 1/3, BHP by 16%, and Rio by 15%, and Woodside cut its dividends by 20%. And so they obviously make up a fair amount of the index. And so that's what dragged the index down. But on the positive side, Charles mentioned some special dividends. There were special dividends from Nine Entertainment, which is selling Domain Group, from JB Hi-Fi, from Super Retail, and I'll talk you through consumer spending in a little bit, and also from Qantas and Helia. So it was good to get some special dividends out there. And there are also some good dividend increases from some of the financial companies as well, and some of the resource companies like gold miners. And gold miners have typically paid at almost zero yield. But it's positive, given the high gold price, they're actually starting to see some positive dividends coming out of gold miners. And some of them are getting up to market levels of yield around that kind of 4 to 5% gross dividend. So that was positive. The other positive is that some of those kind of typical growth stocks, as they're maturing, are starting to pay out dividends as well. So you can see SEEK and REA Group both increased their dividends by 38 and 35% respectively. So it's positive that we're starting to get dividends from that area of the market. Some of the disappointments was Woolworths. Woolworths is losing the battle to Coles quite a lot over the last year. And so fortunately we were expecting a bit of a cut there. It was one of our dividend traps and we were underweight Woolworths at the time. But a cut from Woolworths versus the increase from Coles, and Domino's and AGL also disappointed. If I take you through some of the individual companies, Commonwealth Bank, everyone's favourite, its earnings and dividends were up 4% compared with its stock price, which has been up well over that in the last year. And so the market was actually a bit disappointed by that because it actually produced an inline result. Generally, Commonwealth outperforms expectations, and so it was actually fell 5% on the day. It's doing really well because its bad debts are staying incredibly low, and we expect that to continue given house prices have started taking off again in Sydney and Melbourne. Now, what's interesting with CBA though is that it's not just a lot of the market that thinks they're overpriced, but management look like they think it's overpriced as well, because you can see in August 2023 they announced $1 billion buyback, and they've still only completed 300 million of it, which is what they did in the first few months of when they announced the buyback. And since then they haven't bought back any more shares. So obviously management are viewing it as potentially too expensive, like to get their return on capital as well. But one of the really interesting things that CBA come out with is this chart here. And this breaks down the spending, and this is great coming from CBA because they've got the biggest customer network in Australia. And it breaks down spending and saving into essentials, discretionary for spending, and then saving on the right. And it breaks it down into age category. And so you can see in the pink line in the middle, so the kind of dotted lines that are down the bottom of each of the two lines, they're what happened last year. So they are April to June 2024. And then the thicker lines at the top, they're what happened this year, April to June 2025. So if we went back 1 year, young people were definitely struggling. Cost of living crisis, interest rates had increased, rents had increased massively, and their spending had gone backwards. And that's even, spending on discretionary items had gone backwards. Obviously, there's only so much you can cut back on essentials. But the spending on discretionary had gone backwards, and that was before inflation, so even worse after inflation. And their saving was going backwards at the same time. So it definitely was a struggle for the younger end of the market. The older people were still doing okay, their spending was increasing, and their savings were also increasing. But what's been really interesting and positive from an economic standpoint for the overall Australian economy is that the spending from younger people has now picked back up. And so you can see from the 20 to 24 and 25 to 34, their now spending is increasing in discretionary items, and their saving is also going forward as well. And so that's a lot more kind of sustainable with regards to the overall economy. There's only so much time that younger people can keep on cutting back on their spending. And we've seen that coming through with the likes of JB Hi-Fi, which I mentioned before, announced a special dividend. But its sales are up 10%, earnings are up 5%, marginally above expectation. If you look at their July sales down the bottom, JB Hi-Fi Australia was up 6.1% on last year. JB Hi-Fi New Zealand's doing even better, and we saw that across a couple of companies, that New Zealand is starting to turn the corner. They've been suffering a lot in New Zealand the last couple of years. Their interest rates obviously got increased even higher than ours, but they're starting to spending increase as well, and the Good Guys was also up 4.2%. And so as a result of that, they were able to pay a big special dividend. And what's also positive for JB Hi-Fi is that they announced they're going to increase their payout ratio going forward. And so that means that those dividends are much more kind of sustainable, I guess, in terms of in the past they've been paying out special dividends, but kind of forecasting they might not continue, whereas now they're kind of suggesting those special dividends are likely to continue going forward by increasing that payout ratio. If we look at Telstra, Telstra's result was good. Profits were up 31%. From last year. And what was really positive for Telstra is that while their dividends were only up 5.6%, they're now covering their dividends. So in previous years, Telstra had been paying out more dividends than they had in earnings, and so the market was somewhat worried about that. Obviously, there's only so much time you can continue to pay out more than you earn, whereas now we've actually seen it hit kind of neutral. Telstra is now earning as much as they're paying out in dividends. And the positive thing from that is that then if they have their earnings going forward, increasing, and we're seeing a pretty kind of good environment for the telcos at the moment, whether it's Telstra, Optus or TPG, they're all increasing their mobile prices, which isn't so good for us as customers, but obviously good for their kind of ability to produce earnings and therefore dividends. Their guidance was slightly below expectations, but that was pretty kind of marginal. Another area of the market that we've liked recently, liking a bit less now, but we still kind of are a bit overweight the insurers compared with the banks particularly. And so we like the insurers because post La Nina, when we had those really bad flood years, they were able to increase their premiums by quite a lot. Their investment earnings had gone up quite a lot because now we were seeing positive bond yields. Whereas in the past it had been down at kind of 0 to 1%. It was hard for them to make many investment earnings with rates that low. So they've had those couple of tailwinds. Now some of those tailwinds are going away a little bit because you can see at the bottom of the Suncorp one, their gross written premium guidance is only up mid-single digits at the moment, so around that kind of 5% increase, whereas they had been increasing their premiums by 10 to 15% over the last couple of years per annum. So they're starting to get a few less tailwinds from the premium increases, and then as interest rates are starting to come back down again, those investment earnings should be coming off as well. So no longer as good as it has been for the insurers, but they're still looking okay, particularly compared with the banks. BHP, I kind of mentioned the miners before, so their profit was down 26%, and their dividend was 19% lower on a payout ratio of 60%. It's still a pretty good yield overall in terms of 5.8 compared with the average market yield around 4.5% when you include franking, because they are doing a few kind of development projects like their Jansen project for potash in Canada. And so that's meant they've reduced their payout ratio down to 60%. What's interesting with BHP is to note that their iron ore margin is 63% and their copper margin is 59%. So the last few years, they've definitely kind of gotten rid of all their assets that aren't kind of what they call tier one assets. And so now their kind of assets they're left with are all producing really high margins, which means if prices do fall in the commodity space going forward, they've still got a very large margin for error where they'll still be able to continue earning, continue paying dividends going forward. But obviously, dividend investing, a lot of it is trying to avoid the dividend traps, because as Charles pointed out in his talk, when you get those really high yield names, they're in danger of cutting their dividends. So a big part of our process is to avoid those stocks. And you can see the three here, Accent, Horizon and Woolworths, which are all on pretty good yields. but they all cut their dividends and we were underweight all of them. And so our dividend trap model is still working in the current market environment, and we still think it's valuable to have active management in this kind of dividend environment, given the amount of stocks cutting their dividends. So in terms of Plato's process, hopefully you guys are familiar with this, but if you aren't, there's kind of a couple of different ways that you generally generate high yield in the Aussie market. And the first is by going overweight high yield stocks all year round. And the challenge with that is that you can have a portfolio that ends up being full of kind of financials and resources. And so you miss out on some of those growth areas of the market. So that's the challenge with that strategy. The second possibility is investing in stocks and then selling call options over the top of those. So you're probably familiar with those kind of buy right strategies. And the challenge with those strategies, they can be a good strategy for generating income. The challenge is that if their beta ends up less than 1 and they miss out on that capital upside that you get from equities, then you can end up potentially losing capital year after year if you're producing more income than the total return that you're getting. And so we think, given longevity risk for retirees is probably the biggest risk, you want to have some growth in your portfolio and get that capital growth as well as income. And so that's what we're focused on. And so we actually use a kind of third method of generating income, which is using rotation. So rotating through some of those high yield stocks, collecting their income, and then still having some growth in our portfolio as well. So we want to have kind of good value, good quality, long-term holdings, avoiding red flags, avoiding dividend traps in order to generate that capital growth. So how have we gone? Well, this is since inception in 2011. The top 2 lines are the performance of our fund in dark blue versus the market in grey. So you can see on average we've been able to outperform the market, but we are very similar to the market. And the reason I show this chart is so that you can see that when the market drops 20%, we're likely to drop pretty much 20% as well. We're a beta 1 strategy fully exposed to equities. We're going to move up and down with the equity market with hopefully a bit of outperformance there as well. And then we've also delivered higher income. So the bottom 2 lines are the income that we've generated from our strategy versus the income from the market. And so we're pretty consistent at being able to generate that income and that outperformance. And that's one of the kind of things that Plato is looking to do. We're not looking to kind of shoot the lights out, but we want to get a kind of market-like return, a little bit more, with also generating extra income as well. Now, we've also got a global income strategy, which I'm not sure how familiar people in the audience are with it. But if you want that further diversification, so your clients want income, but they also want to go into global equities, and they're concerned that the average benchmark return, you can see on that left-hand chart, the average benchmark level of income is between 1% and 2%. So it's pretty hard to get income in the global market, but we've been able to deliver almost 6% yield since inception from our strategy. So we get that income, we deliver it consistently. So you can see on the right-hand side the kind of our fund versus the benchmark income per month. So we play out that dividends monthly. And in terms of our performance, you can see the red line is our cumulative active performance since 2011, and the index performance is the kind of dark blue, whatever you call those bars, bar chart. And so when the market was going down in 2022, we were able to outperform over that period. But then when it turned into a growth bull market, when you wouldn't necessarily expect income managers to outperform during that period, we were still able to outperform in that period as well, because we use the same process globally that we do domestically, where we're trying to get those growth stocks as well as rotating through the income stocks in order to generate that income. So we've been able to kind of outperform as well as deliver more income. So in terms of how we're seeing the market going forward, I mentioned dividend traps is a big part of our process. We generate that kind of dividend trap forecast for every single stock on the Aussie market. And what we can do in this chart is aggregate that across the overall market. So calculate what the average chance of a dividend cut is across all stocks in the Australian market. And so when this number is high, that means that stocks are more likely to cut their dividends. So you can see during COVID, there was a massive spike when a lot of stocks cut their dividends. But then post-COVID, it was below average, and we saw big dividend increases in 2021. Now, more recently, we've been kind of trading just above average, and so we have seen those dividends come back a little bit from the resource companies, and that's largely been because resource prices have come back over the last couple of years. And now we're kind of telling clients we're kind of cautiously optimistic. We're not seeing big dividend increases from here, but we're also not forecasting big dividend cuts as well going forward. So in terms of our outlook, we say we're cautiously optimistic. Tariffs are obviously impacting global trade, but the impact on Australia from those tariffs is pretty minor, in our opinion. And so whilst dividends have fallen, those resource prices look like they've stabilised at the kind of, with regards to iron ore, around $100 US a tonne. Looks like it's stabilising at those levels, and so we should be able to see resource companies maintain their dividends, and then that growth from the other areas of the Australian market pick up from here going forward. So thank you for your time. Yeah, these are the 3 funds that we offer: the Aussie Income Shares Income Fund, the Global Shares Income Fund, and also our Global Alpha Fund.